Hello everybody and welcome to the Daily Recap here on Wednesday afternoon, August 29th. My name is Pete Renzulli, Class B member at T3 Trading Group. Today we're basically going to talk about what's available right now. As we start heading into Labor Day weekend, the office here is starting to dwindle and so is the volume. There is really not a massive amount from a market perspective, and normally when you trade you like to have market, sector, and then individual stocks, and you build your trade expectation from there. Something interesting that's going on right now is the volatility and the volume contracting in the market, but the VIX is also going up. So we should be seeing an increase in volatility in the market right now, but we're not. We're actually seeing a decrease where quite a few stocks from the volatility they had in July are seeing their average true range cut in half. So essentially what that has to mean to you as a trader is that it's time for you to reduce your expectation for follow through. Essentially what that means is probably fewer stocks, a lot more specific for what we call your A trades, and more so getting out into momentum into the environment that we're in right now and booking profits until we start to see some intraday continuation patterns in the direction of the higher time frames. Right now, if you've been a trader who's been buying the highs or shorting the lows, you're probably getting slapped around a little bit just because there isn't enough volume to push it through that level, keep it there, and then see the next trade push off to the upside. Today we did have a couple of them. I'll talk about one or two that unfolded pretty nicely today, but first thing, we'll go to the charts. We're going to take a look at the spiders and the VIX. You can see here, I have it in multiple time frames, which is what we normally do. Top left-hand corner is the monthly chart, bottom left-hand corner the weekly, and then the normal daily chart that we see. You can see here the last 3 days in the spiders, after we bounced very cleanly off the 21 EMA on the daily, a couple of days of contraction. Now what that means for you as a trader to start to set up a trade is the more we move into a contraction mode, we can expect a trend day out of that. So we have 1 day, 2 days, and today was not quite an inside day, but clearly the volatility where we're in a very tight range. There's not a lot to do, or the wind isn't at your back at this point. However, as boring or as less opportunity might be available from the spider's perspective at this point, you should be making a list of stocks that are contracting and expecting trend days breaking out of them. So if you want to take your trading to the next level, you want to be preparing now for next week and making your list now of stocks that are holding in there, showing good relative strength, relative weakness, on top of showing a pattern where if and when we break out of this, you're going to be ready for a trend type day. Contraction always leads to volatility, and right now we have a lot of contraction. Now, you could come back and say, well, it's because the volume's late. It doesn't matter. We have these tighter ranges starting to form. When and if we break out of them on good volume, you want to be prepared to catch a ride and not get caught up in, well, the last 3 days was short the highs and buy the lows because we hardly broke through those levels. You don't want to get caught off guard, because if you're not prepared for it going into the day saying, we've had these 3 or 4 days of consolidation, I'm expecting an increase in volatility once we break out of this, which I can actually go to a chart that broke out pretty nicely in the last couple of days, you won't get caught off guard. As a matter of fact, you'll be ready for it and prepared. And that's where all the money is made in trading, is knowing your strategy, game planning your strategy, and then going into the day saying, I expect this to happen today. Most traders get into a problem when they come into the day and say, I'm going to let the market unfold, I'm going to let it open, and then I'll see what happens. You don't want to do that. You want to come in saying, I want to be long these stocks, I want to be short these stocks, and this is where I expect them to unfold today, and I expect a bigger move or to exit into momentum based on the market conditions. So the last couple of days, the better trade has been, for the most part, taking profits as you've had them instead of adding to positions. But if and when sometime over the next day or two, or even beginning of next week, we start to break out of these tight ranges, then you can start to build a position. It's a very common question I get in the strategy sessions that we get in the private mentoring. How and when do I add to positions? And the when is actually more important than how, because all conditions do not lend themselves to saying, here's tier 1, here's tier 2, whatever share size you build up to. The market conditions first have to dictate a higher expectation for follow-through. When you have that condition, that's when you can add to positions. So essentially, when you have a good environment, you get a push up or a push down, you get a consolidation, you're looking to add in a better environment. The one that we're in right now, you get that push up or push down. The odds favor getting out and looking for another idea or letting the stock consolidate maybe for another move. So just getting to the charts, you can see we got a couple of days there, consolidation in the spiders. If we look at the VIX, the VIX is actually rising here. Now that 13 and change level that we had about 6 or 7 days ago is a pretty extreme level. It's actually a low, if I'm not mistaken, for the last 5 years. Now, You don't want to use the VIX like you would normally a stochastic indicator where overbought or oversold, it quote unquote has to turn around and start going the opposite direction. The VIX is measuring the amount of volatility, the amount you can expect, the trade expectation. And what that will do is it'll adjust how long you expect to be in the trade because you'll get bigger swings, and it'll also adjust the share size per trade because the lower the VIX, it's not going to move as much. Maybe you can get in a little more share size because you're not expecting the volatility. But as the VIX starts to increase and starts to bounce, that same dollar amount you're going to risk, you're going to decrease the share size to compensate for a wider stop loss as the VIX is starting to rise for the same dollar amount you're willing to risk. So with the VIX rising right now, we should be having an increase in volatility, and we're not seeing that right now. So we are probably seeing a little bit of the holiday kicking in, people getting ready to barbecue, going to the pool this weekend, but you still have to prepare and notice the VIX is increasing and we're tightening the range. So essentially what that means is next week we can anticipate as a prepared trader to say I expect some trend days out of the consolidation with the VIX rising. So we're going to look at a couple of stocks today that are breaking out of or starting to roll over from pretty consistent uptrends. And then we're going to take a look at how you can quantify some good trades to say every day I'm only going to be long these stocks or short these stocks because of this, and then go into the day prepared for it, and then just adding in the expectation that I just covered, you'll know whether you're going to be getting out into momentum or if you're looking to build a position. So we've got a good mix of what's going on with that right now if we can go to the charts. First sector we're going to look at oil services. We want to look at BHI. This is actually very interesting because it lends itself to exactly the point that I'm making. And I'll just cover the three stocks in this sector: BHI, SLB, and Halliburton. Multi-day consolidations leading to a trend day. That's what you want to be prepared for. Now, more interestingly here, clearly you can see in all of the charts, we've had a nice uptrend going on a couple of months now. However, as we start to push up and roll over, there's two different things you're going to be looking for. One is if you're using moving averages or trend lines, how do I first identify when there's a change of trend? A change of trend versus a potential change of trend, because you can start to pull back, and you know, more often than not, you have the 8-period moving average, the 21, the 50, and the 200. If it breaks one, you have to start to anticipate support on the other. But if you have two moving averages, most people use them as a moving average crossover to identify a change of trend. However, you get a day like this, and more specifically, BHI is probably a little better example, where price clearly is now trading below the moving averages that we're looking for. So a couple of things happened here. We pushed up to the 200-period moving average there on the daily chart, right around $48, and we really couldn't get above it by that much. We pushed up, had the gap, slid above it, and stayed there for about a week and a half, but we didn't have any further impulse price action. So at that point as a trader, you had to be saying to yourself, 48 is the right price for this right now, and I'm not going to do anything until I see a price action move outside of this, or in other words, the way I do it in the mentoring, let the market first tip its hand before you get involved when there is an agreement on price. So what we actually have unfolding right now is a potential change of trend, because now we've closed below these key moving averages. We held that key resistance, and we couldn't get above it by much or have another push through it once we got there. So to confirm the change of trend from potential change of trend, you wait for the moving average to cross over the other side. So it lags, and that's the whole point. First is the potential change with the close on the other side, then the actual change of trend when the lagging moving average joins where the candlestick itself closed. So that's one sector that gave a couple of different good examples there. Holding the 200 as resistance after we bounced up there, had consolidation and price action, which we started this video out with, and then we ultimately led to what is now in that sector a potential change of trend, looking to potentially start to put tactical shorts on there if we have another day to the downside. So a whole bunch of different pieces of price action there to put in to make a good quality decision. All right, so next we're going to go to one that we've been mentioning quite a bit is silver and gold, SLV. Another interesting, as a matter of fact, this looks very similar to what we were just recently talking about on bouncing up to the 200, holding the 200, significant resistance there. However, what I do like about this right now is we've gapped up there, and we haven't even pulled back half a dollar. I mean, that's how strong this gap up and hold was. The general or accepted technical rule, if you gap in one direction, usually you give it 2 or 3 days to fill the gap before it takes off and reassumes the gap if it's a good trade. This hasn't pulled back at all. So again, being a good trader, being prepared now for when the volatility and the volume comes back a little bit, we're going to assume next week, you should be looking at the stock saying it's had very good relative strength and has not pulled back at all. So as a trader, putting that into the context of how do you measure the strength of a move, If a stock bounces up, pulls back, the deeper it pulls back, the less buyers are in there to support that price that got pushed up. It might have been short covering, it could have been just blowing through a level, but if a stock bounces up and goes sideways, there's still buyers supporting that. The shallower the pullback, the more of the buyers are around to support that previous move, and that's exactly what we have here. So the longer it sticks up here around the 200, we're going to feel good about it. And GLD, very similar picture. Pulled back today, but it's also still holding above that key moving average. Something else that's big to notice on charts, and I can give you two very quick tips on recognizing relative strength in stocks and how to do a quick eyeball on whether or not a stock is one that you should be giving consideration from an analytical perspective to say, I want to be long or I want to be short. It's two things. How many gaps has the stock had in the last most recent 4 to 6 days? The more gaps you've had in the same direction, you should be trading that relatively more aggressive in the direction of the gap. One gap, not that big of a deal. If you get multiple gaps in the same stock for whatever reason, whether you're a fundamental trader or a technical trader, that's good impulsive price action, especially if it hasn't backfilled, as I just explained in the last couple of days. The second one is to recognize where the stock has closed relative to the 8-period moving average on the daily chart. I'm very often asked, how do you know which stocks you want to look at in the morning without spending hours and hours and hours? Run a quick scan on whatever software or just do a little homework, elbow grease, go chart by chart by chart, and say which stocks have closed consistently above the 8-period exponential moving average on the daily chart. Those are showing good relative strength or price persistency over time. And the same thing on the opposite side, which actually we can take a look at a stock right now, BTU. You can see here on the daily chart for a period of about 3 weeks, other than that one, it closed below the 8 EMA on the daily chart, ending in some capitulation volume. And then we had about 6 or 7 days, and we're showing some decent price to the upside. So it's a very, very quick way, and we'll do a couple of retail stocks showing the same thing. Macy's here. And again, something that I always get coming back to me during the mentoring is, well, these stocks don't move that much. They're not that volatile. You know something? You're here to make or try and earn money on a consistent basis. Everybody doesn't necessarily need to trade the high beta Apple, Google, Amazon. There's nothing wrong with it. But first prove to yourself you can earn consistent money in stocks that are obvious, and then pick your game up and start to trade at a higher level. If you have a choice to trade a stock that is obvious and matches your risk tolerance, your bank account, your trading account, and your experience level, find the ones like this that are moving consistent and trade them, build up your confidence, build up your mental bank of confidence, and then start jumping into the higher volatility stocks. Nothing wrong with trading them, but Mark, Scott, Evan, all those guys, they have a lot of experience, and you don't want to first just jump in to the pool and say, I want to do what you guys want to do. I'm going to run 100 miles an hour, same as you. Respect the fact that they have experience, but also be excited that the traders that are further down the path than you are showing you ultimately the vision of where you want to be as a trader, which is being able to handle those on a daily, day in and day out basis. But there's nothing wrong with trading these stocks to get comfortable while you're building up your confidence to trade those other ones. So again, if sticking to this sector and actually bringing me up to the last point that I want to touch on here, when you start to see price persistency in the same sector or industry, and you start to see a lot of the same stocks doing the same thing, holding the 8 EMA, holding the 21 with consistency. We'll go to the home builders. Okay, when you start to see a lot of the same stocks doing the same thing, there's money flowing in and out of those sectors, and that's a level deeper in your game planning where you say, you know what, there's more than one stock in the same industry and sector that something is happening. I want to gravitate towards where money is flowing into or out of, because you have to know the difference between your A trades and everything else. And it just stands to reason, if you're trading and trying to build your confidence, you want to go where the money is obvious. It's one thing for one stock to be obvious. It's another thing for all of the stocks in that individual industry to have money flowing in at the same time, where they're all above the 8. Maybe they have all big green candles, or below with all red candles, with consistency. You're looking for price persistency. You look at yesterday's close, what you expect to happen on the open today, but before all of that, you have to know whether or not you want to be long or short only. So it's a big key. Volatility leading into what you expect to happen, taking it into the individual sectors. So as you start to do your game planning, use these tips to come up with the best stocks to trade tomorrow, and you can type those into the VTF and hopefully make some money with them too. I'll see you guys tomorrow morning.